And let me get Matt Orton on, Head of Advisory Solutions and Market Strategy, Chief Market Strategist as well at Raymond James. Matt, very good morning to you, and thank you so much for joining in. As we look at all of the action, India and Indian equity in a bit of a standstill right now between the big GST reforms on one end and the tariff concerns on the other.
Hey, good morning, Tamana. It's always great to join. And yeah, unfortunately, there's a lot of data that's still yet to come out, and India's caught in the crosshairs not only of a number of geopolitical tensions that are playing out, but they happen to be coming off of an earnings season that hasn't been as strong as I think a lot of investors would like, given where valuations are for the market. And so it sets up a little bit more challenging front for India. But what I take solace in is a lot of companies with good fundamentals have been rewarded. So it's been a fairly bifurcated market in India. And so at least companies that have beaten expectations, companies where you're seeing strong growth that you would want to see, given where the overall country's economy is, those companies have been rewarded. And so I try to lean into long-term, durable, secular growth themes that can look through a lot of the noise that we're dealing with out there. You can't completely escape it, but you want to have insulation on those fundamental drivers of the companies you own. And I think you can hide out there until we get through this and then maybe add some cyclical positioning to go along with it.
Hi, Matt. Morning. I'm just wondering whether you're assuming the base case is that this will roll back one, and you've spoken about individual counters here in India in the past. I wonder, based on what we've seen over the past couple of weeks, whether you've changed your view on any one of them, or do other stocks beyond what you had spoken to us about? I think you'd spoken to us about private sector banks and specifically ICICI, but do you look at others that have maybe dropped a little bit, look more attractive on the valuations?
Yeah, absolutely. It's a good question, Alex. And I think any good risk management system, you have to lighten up on positions that have done really well over the long term. So ICICI Bank has been one of my longest held positions. It was the largest position in one of my portfolios, but I had to cut the weight. Just from a technical perspective, the stock hasn't been working. I dare to say management maybe misstepped as well with respect to some of the increases in deposits that they tried to impose and then started to walk back. So while I have a ton of confidence longer term, I still have a meaningful position. I've reduced it a little bit and instead looked at some of those other long-term durable trends like travel. We're seeing pickup in real-time travel data that's very encouraging in August. And I think there's a lot of expectations for delayed travel that was put off in the spring and early summer. So a company like Make My Trip, which is a large online travel aggregator, I think it looks fairly cheap, and I think there's a lot of room for valuation expansion on a company like that, as they probably surprise to the upside in upcoming earnings. And then Eternal's been another holding of mine, but to complement Eternal, because it's quite expensive, looking at a company like Swiggy, where again, you have long-term durable growth themes with respect to quick commerce, with respect to food delivery. But here's a company that I think is a little underappreciated. They're getting their cash burn under control. So I would expect if you're able to continue to see strong gross order volumes and also the Max Saver program paying off, I think you can also see multiple expansion there along with growth on the top line. So that's another name to keep an eye on too.
Matt, the other question would be that does, from a global watcher's perspective who is looking at India and looking at either investing or not investing in India or EMs, et cetera, does the resolution of the tariff stalemate be the linchpin of your decision? Or could India, which is largely a domestic economy, doing deals with other countries, so on and so forth, et cetera, and the fact that it impacts 0.7, 0.8% of GDP and not more, this whole tariff issue in the US. Is all of that also an antidote to the sentiment currently?
Yeah, Neeraj, I wish it was an antidote, but I don't think it is, because you have other emerging markets like China, like South Korea that have done so well this year. And China has been able to take advantage of tariffs and promote their own semiconductor building in the country. And you're seeing really strong gains and strong earnings prints from their internet giants. And it was cheap. And so a lot of foreign investors have moved capital to countries like that. And then you have Latin America or Brazil that's at all-time highs because Lula might not be running for re-election again. So you have a lot of animal spirits being unleashed. But I think India will set up once sentiment switches, whether or not that comes because we have some resolution with respect to tariffs, or there's some good marginal news perhaps from investments that might come from Japan. I think any sort of incremental good news is going to be a positive, not only for domestic investors, but for foreign investors to say maybe the market has gotten cheap enough and maybe there might not be that much of a dent to growth, and therefore we can support the level of valuations that there are. But I think it's going to take time. And honestly, the biggest headwind to India, I would argue from a foreign investor standpoint right now, really comes down to sentiment, just around the ability to get over earnings and start to grow again. And once we can clear one or two of these hurdles that are out there, I think you start to see a change with respect to capital allocation.
Matt, in terms of the big meetings that are happening this weekend, and this is something that we're looking at very closely strategically, right? Prime Minister Modi is going to be meeting Xi Jinping. He'll be meeting Mr. Putin as well. What do you see as the possible impact of more cooperation, more trade deals between India and China right now?
Yeah, Tamana, it's kind of ironic that tariffs were, I think, partially put in place to help prevent the BRICS nations from coming closer together, especially China and the others. And it's having the opposite effect, unfortunately, from a geopolitical perspective. But I think India knows where it stands with respect to geopolitics. There's history with China. There's challenges. The relationship with China, I would argue, is very fraught. So I think part of this meeting it's long overdue. I think there needs to be a resolution with respect to the ability to import components that are key to India, like solar inputs, in order to realize the plans that Modi has put in place with respect to clean energy production, stuff like that. But I think it's also perhaps a negotiating symbol with the US that there are alternatives. And especially, I would argue the meetings with Japan are perhaps more important than that, even symbolically with China, because Japan already has a history of investment in India. You look at the partnership with Suzuki and the success of Maruti Suzuki right now. You talked about the bullet trains at the start of this segment. So that, I think, could yield a strong chip for Modi, because if an ally of the US like Japan, who's also frustrated with tariff policy with the US, can strike deals with India, perhaps it shows that maybe tariffs aren't as potent of a force as Trump may have thought, and maybe it brings people back to the negotiating table.
Okay, so important point. Matt, we haven't spoken about it so far, but I'm just wondering, because you're so close to everything that is happening with monetary policy there and with the construction of the Fed, standing outside and looking in, it seems that there is a bit of a threat to the independence of the Fed, something that you last perhaps saw with Nixon. And it's been a long time since that's happened. So I'm just wondering how investors are looking at Treasury, or investors are looking at the construction of the Fed. Is that a big concern for you looking in?
Yeah, I think it's a concern, but it's not a top-of-mind concern. I think the top-of-mind concern is inflation and what's happening with respect to very sticky inflation and the likelihood of Fed cuts coming in front of that. I do think the uncertainty with respect to the independence of the Fed is being reflected in the back end of the curve, because you're seeing the front end come down as you would expect when you start to have interest rate cuts, but the back end, the 10-year to the 30-year, has been pretty stubbornly high, and unfortunately that's what mortgage rates are tied to, that's what auto loans are tied to, and so you're not getting the relief that the consumer needs, because all of those additional concerns are reflected at the long end. And so I think the market, in a way, is trying to tell those in power that, if you keep testing things, you could end up with a situation that moves out of control. So I continue to think longer dated yields in the US remain fairly well supported, but that turns out to be good, at least for now, for banks, financial institutions, for net interest margins. So at least as an investor, there are things that you can do around that as we wait and see how all of this plays out.
Okay. Thank you so much for that, Matt.